Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Daybreak Europe podcast, available every morning on Apple, Spotify or wherever you listen. It's Wednesday the 9th of October here in London. I'm Caroline Hepker.
And I'm Stephen Carroll. Coming up today, the US government considers breaking up Google over its dominance of the online search market.
Jamie Dimon, JPMorgan CEO, says that London risks falling further behind New York's IPO market if Labour doesn't follow through on its promised reforms.
Plus, France's budget crunch. We have a special report on investors falling out of love with French debt over what one economist has described as fiscal murder.
Let's start with a roundup of our top stories.
The US Department of Justice is considering a historic breakup of Google as a possible remedy in the monopoly case it won against the company in August. The regulator is contemplating forcing the firm to sell off parts of its operations as it seeks to prevent the tech giant from using its products, including Chrome and Android, to dominate the search industry. Speaking to Bloomberg's The David Rubenstein Show peer-to-peer conversations for an episode set to air this week, Alphabet and Google CEO Sundar Pichai played down the idea that the company's competition battles pose an immediate threat.
We definitely disagree with the ruling, but we're still in the middle of the remedies phase, and we will appeal, and this process will likely take many years. And I'm confident, given that we are focused on innovating using technology, we'll do well in the long run.
That's Alphabet CEO Sundar Pichai speaking there to Bloomberg last month. Responding to Tuesday's Justice Department filing, Google said its proposals would have significant unintended consequences for consumers, businesses and American competitiveness.
Chinese equities have led losses in Asia as traders weigh weak economic data and Beijing's reluctance to commit to more stimulus. The benchmark CSI 300 index tumbled as much as 7.4% in its biggest fall since 2020. The drop more than wiped out the previous day's gains when stocks surged following the end of the Golden Week holiday. The latest moves come as a growing number of strategists and fund managers say that Beijing needs to back up its spending pledges with fiscal measures. Here is Nicholas Yeo, who's head of Chinese equities at Aberdeen.
The base case is still to follow through, right? I mean, it would look very bad if there was no follow through. So everything is like, the expectation has been built in. And if there's no follow through, it's not just affecting global investors. I think the key here is that the domestic investors are also in the market right now. Right, people are opening an account and they do not deliver. The credibility issue might be back again, right? Because we have many false dawns. Can the government afford another one, right?
Nicholas Yeo's comments show a mismatch between equity investors and officials in Beijing, who expressed confidence on Tuesday that they would hit an economic growth target of about 5% in China this year.
Jamie Dimon says the UK government will have to make changes to capital markets if they want to stem the flow of companies that are opting to list in New York over London. In July, British regulators overhauled their rules for companies looking to make their public debut in the UK as part of a concerted effort to draw more initial public offerings to the city. Speaking exclusively to Bloomberg, the JPMorgan chairman and CEO said the mood music from the new Labour administration is positive but needs to be backed up by further action.
First of all, I love the fact, if you listen to the current Labour government, they're talking about growth, investment, markets, capital markets, and things. And they do need to do those things to help it recover. If they didn't do those things, no, I think it'll become more permanent. And a lot of people, they go to the United States, there's more liquidity. It's easy to do. I mean, or they have a lot of business there, which also making this a great business environment will also help companies going public here. But right now, the NASDAQ, the New York Stock Exchange, they're just more attractive places to go, and we'll see how that pans out.
Jamie Dimon's warning comes as London's stock market continues to battle a lack of IPOs, with firms including chip designer ARM instead opting to list in the US with its deeper capital markets and prospects for higher valuations.
Britain's shift into faster settlement of trading is running into a problem. Its currency. The UK wants to join the US in settling equity trades one day after the deal is made, which is known as T+1. But Bloomberg has learned that the chair of the group spearheading the transition, Andrew Douglas, is warning that unlike the US, the pound is not a reserve currency and is less liquid than the dollar, so the UK has to take a different approach. Currency trades typically take 2 days to settle, so the planned shift in the UK on equity trading in 2027 has the potential to dislocate the market.
Hurricane Milton retained Category 5 strength as Florida residents fled the coastline ahead of its arrival. The storm has the potential to be one of the most destructive hurricanes ever to hit Florida and is expected to cause devastation across the state. Florida Democrat Kathy Castor says anyone in an evacuation zone needs to leave now.
This is an epic catastrophe. I mean, Hurricane Helene was less than 2 weeks ago, but there are still some people, I've heard from them even this morning, who think, okay, well, I'm going to go to the second floor and ride this out, even though I'm in an evacuation zone, and they need to take stock of their lives.
Representative Castor called for long-term disaster relief in an interview on Bloomberg's Balance of Power programme. The hurricane is expected to make landfall on Wednesday night.
The storm is likely to cause at least $75 billion worth of damage. Investors in catastrophe bonds are girding themselves for substantial losses as the combined destructive force of Hurricanes Helene and Milton are expected to trigger payment clauses on a scale not seen in years. The full story now from Bloomberg's Charlie Pellet.
Catastrophe bonds, or cat bonds as they're known in the industry, are issued by insurers and reinsurers to provide financial protection against the most severe natural disasters. Investors who buy the bonds stand to make large gains if a predefined event does not occur, but can lose a big chunk of their capital if it does. 2 weeks after Helene unleashed severe floods in more than 24 states, Florida is bracing for the impact of Milton, which is expected to make landfall early Thursday morning. In New York, Charlie Pellet, Bloomberg Radio.
We're watching closely what's happening in China, and in fact we've had some more detail. The Chinese Ministry of Finance is going to brief people on fiscal policy on Saturday. So the Finance Ministry talking about holding that briefing on the 12th of October at 10 a.m. So this actually has already started to affect equities being traded onshore in China. So the CSI 300 pulling back on some of the losses. Currently we're down by 3.8%. So that's, I think, an interesting point to bear in mind as we've been waiting for those details, further details from Beijing.
Yeah, and indeed that's been something that's been a dominant theme on those markets since they reopened from the holidays. We're going to get into our story around the French budget and how investors have been perceiving French debt in a moment, but we're going to bring you first to the news out of the US Justice Department considering whether to force Google to sell part of its operations as one way to resolve a monopoly case over the dominance of its search engine. Could be the biggest move to rein in a major tech company since the failed attempt to break up Microsoft 2 decades ago. Our tech editor Vlad Savov is with us for more on this story. Vlad, what exactly is then the Department of Justice proposal, and is it a threat to get Google to change its ways?
Yes, I would think that what we're looking at the moment is still very much a form of negotiation by lawsuit, so to speak. The starting point for this is there already has been a ruling to say that Google has been in breach of antitrust laws in the US. What we're doing at the moment is the DOJ is putting forward proposals to look at the remedies that should be considered by the judge in making the final judgment. Those remedies will guaranteed be appealed by Google because Google doesn't feel like it's operating any illegal monopolies, and there's a back and forth between the two. The main thing to say here is that it's a highly complex situation, and the DOJ points out that whatever remedies need to be implemented, they can't just rewind the clock. The situation is as it is, and they need to look forward, and they need to make sure that Google doesn't have antitrust powers in the future. And part of that, like, let's say the most extreme part of that, may be the consideration of breaking off some of the businesses.
So what's Google's counter-argument then?
Oh, Google's counter-argument is that if you break off those businesses, you break them.
Right.
So things like the Chrome browser and the Android operating system, which is the most dominant one in the world, would effectively break without Google being able to have the control and the network effects that it currently enjoys. Google's argument is to say that these things are being provided for free at the moment, some elements of them, and it's worth highlighting, it's just elements, not the entire software stack, are open source, and without Google having and enjoying the current position that it enjoys, people will lose out, especially users will lose out, and some of the other remedy measures, such as sharing Google data, such as sharing a person's search results with potential competitors in the search market, Google argues endangers the users, it endangers their privacy and security.
How does this particular case compare to the scrutiny that Google has faced from other regulators, notably in the European Union?
Well, it is very much along the same track. I mean, worth bearing in mind, this is one of several lawsuits in the US. It isn't just search. There are other Google businesses that all the regulators are looking at. In the EU, the digital regulation chief, Vestager, she has pointed out that as far as the ads market, the online ads market goes, Google is in a position where it both owns the marketplace and owns supply and demand companies. So that's something that both Europe and the US are looking at closely.
What does all of this mean for other big tech firms, Vlad?
It's difficult to say because there isn't another Google, to be honest. The closest thing to it is Meta because it enjoys such a large audience with Facebook and Instagram and the like. But there really isn't another Google with the breadth of services that it has. I mean, bear in mind, services like YouTube could very easily operate as an individual business. There are several CEOs under the Google CEO. It's a huge company. So what sort of precedent it sets for others, I'm not really sure because Google doesn't have a matching company out there.
Okay, a story we'll continue to watch with interest. Vlad Savov, thanks so much for joining us with the analysis of that news on Google.
When France's president called a snap parliamentary election back in June, investors took fright. The country's borrowing costs jumped and the months of political deadlock have seen the fiscal and economic situation deteriorate. Bloomberg economics reporter based in Paris, William Horobin, has been writing about this ahead of tomorrow's budget announcement from the new Prime Minister Michel Barnier. And Will joins us this morning. Hi. What's happened then to France's standing with investors? What's happening in the bond markets has been something we've tracked closely.
Yeah, good morning, Stephen and Caroline. Well, France used to be sort of a semi-core country, a sort of proxy for the safest German bonds that offered an attractive and small premium to investors. But now deficits have widened suddenly and the economy is misfiring at the same time as the political outlook has become very unstable after snap elections delivered a hung parliament this summer. And that's quite a contrast to, I said, maybe a decade of stability that included a large part of Emmanuel Macron's presidency of France. And he sort of turned the country into, to some extent, a sort of poster child for economic growth and gradual repair of finances after the Eurozone debt crisis. But it's now sort of become a poster child for fiscal difficulties that are hard to fix. And as investors dump French bonds, as you mentioned earlier, the spread between the country's 10-year borrowing cost and that of Germany's has widened to nearly 80 basis points from between 40 and 50 before the elections. That's a spread that in the years to come is going to cost, over time, if it continues, will cost billions of euros a year to France.
So what's gone wrong then with the country's finances and economy?
Well, before the elections, Macron had a workable majority, although not an absolute majority in Parliament. And then in June, he surprised observers, certainly, and even his allies, by dissolving Parliament and betting that he could get more stability and stem the rise of the far right with elections. But that sort of backfired spectacularly. And the National Assembly is now made up of three deeply divided blocs that are unable to govern alone and allergic to working together. After several months of talks, Macron finally managed to appoint Michel Barnier as Prime Minister, but Barnier's party has fewer than 50 seats in the 577-seat Assembly. So the maths of all this means that the Barnier's government could easily be toppled in a no confidence vote. With the left is already pushing for that, and so that sort of hands the keys, not the keys to power, but it hands a lot of power to the national rallies, Marine Le Pen, because if she joins the no confidence vote, then this government falls.
Yeah, in terms of the next steps that we're watching out for, then, what about the budget, which is obviously clearly the top job for Michel Barnier to try to deliver?
Yeah, this is what we're certainly watching this week, and there's been quite a lot of build-up to it in recent days. He's due to present the budget on Thursday evening. He's already warned that we're looking at 60 billion euros of savings that will be required to get the deficit to 5% of economic output from 6% this year. That's a crucial first step in getting towards the EU limit of 3% in 2029. However, these savings are really going to hurt, with 40 billion coming from spending cuts, which is a large amount for France in 1 year. And it could hit anything from pensions to social security to apprenticeships and training. And on top of that, there's 20 billion euros of tax increases that are going to hit big businesses and the wealthy. And that's a very risky strategy for Macron, who has built his reputation on the sort of pro-business approach. And a lot of his allies say that this is key to jobs and investment.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.